Hey guys, it's Carter. Welcome back to the channel. Hope you guys are all having a great and amazing day today. Now in today's video, we are diving in and looking at Warren Buffett's rules for buying stock. We're going to be looking at his top 5 rules for choosing companies. So I hope you guys all enjoy it. If you guys get anything in value out of this video, hit that like button, subscribe. If you guys are new to the channel, new to the team, we talk about everything money, stocks, money management, trading, investing. So subscribe, join the team. So let's dive into this one. Now, I think we all know that Warren Buffett has been rated one of the best investors of all time. And now the reason why a lot of people say that and think that is because his average return rate per year is about 17% compared to the S&P 500, which is about 10%. So meaning he is outperforming one of the best investments of all time. So it doesn't come at a huge surprise that he's worth billions of dollars. All right, so Warren Buffett's first rule is pick quality over quantity. You'll never see Warren Buffett actually going out and buying a struggling company. Personally, he would rather buy a good company at a fair price rather than a fair company at a good price. For him, it's all about quality. He really loves to invest into companies that he knows. That's super, super important for him. He really loved brand recognition, which doesn't come at a huge surprise because some of his largest investments are some of the most popular companies in the United States, like Apple, like Coca-Cola, Verizon, and a variety of other American icons. So for Warren Buffett, he would rather just buy a very, very good stock rather than a bad company trying to buy low and sell higher. The second rule that Warren Buffett follows is don't follow the crowds. Now, I think we all know, during the AMC, the GameStop era, where everybody's investing into those companies, the stock skyrocketed up. And yes, there was some people that made a ton of money off it. But on the flip side, there was a lot of people that lost a ton of money. Anytime you follow the crowd, the volatility goes up, the risk goes up, and really the reward doesn't even go up that much. So for him, he would just rather be kind of on the outskirts, just picking those high quality picks rather than following what everybody else is doing. And honestly, I get it, because if you're following what everybody else is doing, most people don't know what they're doing. So he just would rather do his own research and all that good stuff before picking and choosing different stocks. The third rule that Warren Buffett always loves is don't fear stock market crashes and corrections. For Warren Buffett and myself included, you have to look at crashes and corrections as opportunities to buy companies and ETFs at just a more affordable price. He always says, imagine if your favorite store had 20 or 30 or 40% off. You would absolutely love it, being able to buy things at a more affordable price. In the stock market, it's the exact same thing. Anytime you have a crash, you have companies that are an absolute bargain. So he would rather just invest in those companies at a lower price and not fear a crash. And with that being said, buying during stock market crashes, it pretty much doubles your average return rate. The average return rate of like the S&P 500 is about 10%. Now, if you buy during stock market recessions, it jumps from 10% all the way up to 22%, which is pretty much doubling normally. All right, the fourth rule that Warren Buffett always follows is having a long-term approach. You'll never see Warren Buffett himself like day trading or swing trading different stocks. He is somebody that will just invest and pretty much forget about it, because his mindset is always, a decade, 2 decades, 5, 10 years out. It's never like I'm buying this month and I'm selling in a month. He's always on a long-term approach. All right, the fifth and final rule, before we jump into that, hit that like button and subscribe. But this rule is don't be afraid to sell. During 2007, Warren Buffett bought a mortgage company and a mortgage insurance company. He soon realized these companies were taking on a ton of risk, and he actually sold their shares. Now, obviously, in 2008, the financial crisis hit, and that same company fell about 50 to 60%. So he already sold his shares. So he didn't like their business practices, so he sold their shares, and obviously it paid off big time for him. And another thing that I kind of would recommend, I have never lost money taking profit. So if you're nervous about a stock and you're up on your money, don't be afraid to just sell it and push it off to the sidelines and sit on the sidelines and then watch what happens. There's nothing wrong with that, and I do think that's a great approach for a lot of people, just because a lot of people have emotions involved, you know, when it comes to investing. So you invest and you're up on your money and you think you're gonna double, triple. And if you're nervous about it, I've never lost money taking profit and just sitting on the sidelines. So guys, these were the top 5 Warren Buffett rules. I hope you guys enjoyed it. If you guys did, hit that like button, subscribe, and we'll see you guys in the next one. Take care.